Hi, I'm Barry Clark. Welcome to the Mortgage and Property Podcast, brought to you by Mortgage Monster. Now sit back, relax and get ready for top tips, tricks and advice to help you with all of your mortgage and property needs. Hello and welcome to the Mortgage and Property Podcast. Hope you're doing well today. I'm joined today by Adam.
Hello.
Adam, introduce yourself.
Yeah, I'm Adam, as Barry just said. It's hard to introduce yourself when Barry takes all the credit. So, I'm the marketing guy, marketing boss man.
That's what you're going with, is it? Marketing boss man?
That's what I need to know. All you need to know.
Marketing boss man and tea maker.
Yeah, no, I never make the tea. Never make the tea. It's not my job.
Okay, cool. So Adam's helps out today by asking some questions.
Yeah.
Over the years, we have heard some very weird and wonderful things about mortgages, and usually it comes from Steve or Dave down the pub. So today we're going to try and debunk some of those myths. So Adam, you've got some there?
I've got some myths that I wrote out earlier, helpfully. So there you go. Here's number one. It's impossible for young people to get on the property ladder.
It is something that we hear a lot. But it isn't. It just means that people have to do stuff that sometimes they wouldn't necessarily do. So, for example, I don't think that today, if you're a first-time buyer, if you're in your early 20s, it's going to be maybe quite hard depending on where you are in your, in terms of your job cycle and what you're doing for work. Maybe you won't be able to get the same as what your parents could get in maybe when they were in their, early 20s, 30s, when they got their 3-bedroom home. It might mean, for example, you may have to start off in a flat, for example. And we did an example going back a little while ago about two first-time buyers, both saving £300 a month. If they say £300 a month each, by the end of kind of 18 months, they'd have enough to be able to put down a 5% deposit. As long as they're both on more than, say, 20, 22 grand a year, then potentially they'd be able to buy a flat for in excess of, say, £180,000. So it's not necessarily, I don't think, impossible, but it's all sometimes about what you have to give up. So, for example, we see a lot of kind of first-time buyers coming to us. They might have £300 or £400 a month of kind of car finance payments. It might be a case of, okay, you might have to drive a banger for a little while, put the money towards savings and save up, and maybe get to that deposit. But impossible, no. But you might have to kind of re-evaluate exactly what it is you want and what you want to live in, basically. But whatever it is, I'd hope it's going to be much better than you actually renting somewhere, because renting is literally throwing your money away. I know this, you're about to embark on a rental. Wow. And, at the end of the day, when you come out your rental the other side of that in 12 months' time, what we have to show for it.
Yeah, bugger all.
So, look, it's not impossible, but it just does require a little bit of hard work. But, let's see what we can. It's something we work out. It's very, when we do these things, it's very kind of area dependent. We'll have some people who live in central London, which are going to find it difficult to find a property in Westminster, for example, as a first time buyer for 160 grand. We get other people who live in the north of the country in Scotland. They go, God, for 160,000 pounds, I could buy a 3-bedroom house. So it's very, very kind of area dependent as well.
Yeah. Well, summed that up very well.
Thank you, mate.
Number two, I've got. You have to get a mortgage with the bank you're already with.
100% no. That is complete and utter codswallop. Say that polite, yeah. Gonna just not swear. I just want to make sure I don't say these swear words. But basically, it used to be that way going back kind of 50 odd years. Is the fact that you'd go to your bank, you have a relationship with, you say, please sir, please can I have a mortgage? I'd really like a mortgage, please. And they'd kind of go, no, only if you have to have 25 years, you have to bank with, you have to this, you have to do that. Now you haven't got to do anything you don't want to do. You can go to any bank you want. You don't necessarily have to bank with them. My advice would be, look, speak to a broker and just have a look and see which banks you do fit with, because all banks have different criteria. And whilst you might fit sublimely with one or two, you might not fit with one or two of some other ones. So just because you've been to your own bank and asked them their opinion doesn't necessarily mean that opinion is correct from all banks. So, for example, we had a chap who went to his bank, which is Santander. They worked out what he could borrow. He was a self-employed. He was like he was a plasterer. So he's only kind of about 170 quid a day. But when we went to his bank, which is Santander, they only lend him something like 100 or grand. We sat down with him, looked at his looked at all of his CIS vouchers, which if you're construction industry is what you'll get paid in. And there are other lenders who will understand these. And with another lender, which was Halifax, we managed to get them around about £180,000 worth of borrowing. So just because you've been to your bank doesn't necessarily mean that sets the standard for all banks, because they're all slightly different.
Yeah.
But no, you definitely don't have to get a mortgage with the bank you're with.
That's the good thing about going to see Mortgage Monster. We've got loads of different lenders we go to, isn't it?
Yeah, exactly. We can work with upwards of it's almost 100 different lenders. We can even go off panel and go to another kind of 50 odd more if we've got anything weird and wonderful.
Yeah.
Yeah, 100%. We'll have a look at what your personal circumstances, understand what that is, and see how we can. It's just understanding lenders' criteria, and where you'll fit with one means you might not fit with another one. So it's just about finding out what's the most important thing and how we can get to really where you want to get to.
Cool. The next one is it costs more to pay for a mortgage than it does to rent.
Sometimes it could do, potentially, but more often than not, it actually doesn't. More often than not, we can look to maybe put your mortgage over a certain period, maybe over a certain term, and that might bring the kind of payments down a bit. Now, potentially, you can mortgage. Some lenders will allow mortgages up to, on your earned income, up to say age 70 or 75 years old. So it means that, we can have a relatively long term for you. On the basis of that, we've had loads and loads of people when we put posts out saying they would actually rather. The feedback we're getting from a lot of people is that they'd rather not have a mortgage. Like, I know we did a post before about asking people, why don't you want a mortgage? No one replied to that, did they?
No.
But every time we put a post on Facebook, lots of people go, I don't want to have a mortgage. I don't want to be tied in for 25 years. I don't want to be tied in. But I can't understand why people wouldn't want to own their own home. Do you have any ideas to why you wouldn't want to? Is it because people maybe are scared?
Maybe. I think the deposit's the big thing, really. You save up a lot. The deposit is a lot of costs in the first bit before you're actually save. That's the main thing. Saving all that money. That
is going to be difficult if you're already renting, if you're already spending your money out. But good habits will help, and over a long enough time scale, it could be possible. So rather than staying up for 18 months, yes, it could take maybe 2 years or 3 years, but even just, if you can set aside £50 a month each or whatever else it is to kind of help towards that, it might not help you right now, but I think it will definitely help in time.
Yeah. The next one I have is getting the lowest interest rate on a mortgage will result in the best deal.
No, it won't. Okay, so basically, the only way I can kind of make this make sense is by right. There's two ways of pricing. Say, for example, you're flying from here to, I don't know, Paris, for example. You're going for a long weekend with your girlfriend.
Nice.
You only have half a going away. Flying to Paris, for example. Yeah. You've got two options. You either fly with EasyJet or you can fly with, I don't know, Air France, for example. Right. When you book with EasyJet, it's actually only $4.99 to fly from here to France, which looks amazing. The ticket's only $4.99. Just be aware, when you buy that ticket, you've still got to pay airport taxes. You've got to pay for your lunch. You've got to pay for this, that, and the other. So your $4.99 flight might end up being 60 quid. You might also try and book the same flight with Air France or British Airways, and that actually costs £60, but everything's all included in that. But just because you're being offered £4.99 flight from here to Paris doesn't necessarily mean that's going to be all of those costs. So mortgage lenders operate in a bit of a similar way. So we generally try and market to two different types of people who want the lowest rate, and people who want to have potentially the cheapest deal, want to have the lowest monthly payments. It's by one of two ways. So, for example, wherever the lender might be, they all do is, whether it be Nationwide, Barclays, Santander, whoever else it is, they'll all offer a slightly cheaper product with a fee, or a more expensive product with no fee. So what we want to do is we want to work out how much those costs all in all are. So what we'd look at is, if, say, for example, you're fixed for 2 years or fixed for 5 years, we'll work out all the costs over the 2 years or 5 years. It might be 24 months X amount plus the fees, and we'll compare that then to the other one, which is slightly more expensive, so 24 months plus no fees, and we'll look at the total cost of that, a bit like you would if you were flying to Paris, but you use Skyscanner instead, and other websites are available. You'd use, Skyscanner, whatever I said, to look at the total cost of those all in all. So that's what we do in mortgages. We'll look at the total cost of the mortgage overall, including all of the costs, all of the fees, and that sort of stuff. So just because it's the lowest percentage rate doesn't always mean it's the best deal. So let's look at the overall cost of that, because nobody wants to be kind of think they're really getting a cheap deal and then being sucker punched then by kind of tons of fees and that sort of stuff. So let's look at the overall cost of the mortgage over the fixed term.
Yeah.
That makes sense?
That does make sense.
Oh, cool.
The next two, I'm going to kind of group them together. You know what I mean? You can't get a mortgage if you work part-time, or you can't get a mortgage if you're self-employed.
Oh, those are two very, very big. I mean, the self-employed one is huge. So you can't get a mortgage if you work part-time. Cool. You know, potentially, yes, you can. I mean, there are different lenders that will look for all sorts of income. So generally, lenders will look at your income. You put it into a calculator and they'll give you the amount. They'll look at your outgoings as well, put that all into a calculator and give you the amount which you've got left over, and that will dictate normally how much you can borrow on a mortgage generally. Now, all lenders work on different criteria, and that's what they will and what they won't do. So, say for example, you had a case whereby someone worked part time, they might get child benefit, maintenance, some sort of PIP payment, might get all these different bits and pieces. So her income to one bank, or their income to one bank, might look like £25,000. If we take that same income, we go to a different bank, that might only look like £6,000. So really, it's working out all of the income that the clients have, whether it be whether they work part time, whether they have PIP benefit, whether they have child benefit, whether there's. So we like to look at all of the income, work out where it fits with what lender, and providing it's affordable, we can look to maximise the amount a client can basically borrow. So that's whether they work part-time or they get benefits or whatever else it might potentially be. So can you get a mortgage if you're self-employed? The answer is yes. But lenders are going to if lenders are going to lend to you, they want to understand how your income works. So, for example, if you're straight self-employed, lenders might look at tax returns, and most of those will average them over, say, 4.5 times those incomes. They'll normally average the, your last 2 years or 3 years tax overviews, tax calculations, get an average of the two. Some lenders will even do 1 year. So, as an average, you're going to look at your last 2 years, including all the costs you've taken off for all of your materials and everything else that you need. Basically, they want to look at your net income. So limited company directors, that's a little bit different. Some lenders will still look at your tax over tax calculations. However, some of those will actually look at your dividends plus your salary. We've even got a few lenders that work on your net profit plus your salary, and they normally average that over, say, 2 or 3 years. If you're self-employed as like an IT contractor, or someone who's kind of relatively high level, some lenders also take day rate as well, which will be, by the time we look at that, might look as being a much higher income than just looking at your tax overviews and tax calculations. And if, say, for example, you're a construction worker or you work in the building trade, a lot of clients don't actually know they're on CIS vouchers when they are. All CIS vouchers basically mean is the fact that you get you will get the person who pays you, they hold back 20% of your pay and they give it to the government. Then at the end of every tax year, then you do a tax return. Hopefully you'll get a bit of that back because you say you've got some costs, basically. If your income structured in that way, that means you're on CIS vouchers. So what that means is, to one lender, you might do your tax return, you might look, you're on, say, £25,000, for example, and they might only lend you £110,000. If you went with a different lender that understands CIS vouchers, then potentially they might look at you as being on 170 quid a day, is 40 grand a year, which is £180,000 that you can borrow. So it's an extra £70,000 worth of lending just because we went to a different lender. Obviously, we still have to make sure it's affordable and that sort of stuff. There's always other caveats, but basically, with self-employed, it's about understanding the client's income and picking the right lender, because yes, if you went to the wrong lender, it's going to be a bit rubbish.
Yeah.
I know that wasn't exactly a short answer to that question. It's quite a long answer to the question, but self-employed is like mahoosive.
Yeah.
So you can't. Yeah, it'd be easy if we just go, that's not true, you're a big liar, and that'd be the end of that. But you're doing about 20 minutes.
Right, my next one is, getting a mortgage will take ages.
Depending on lender, yes, sometimes it can. So when you say it takes ages, really, it's all about the preparation for it. So the more you can prepare for it, the quicker it's going to be, basically. Yeah. If you come to me with all your paperwork ready, we're going to tell you need, your ID, your bank statements. We're going to need your last 2 years self-employed, lots of income. yes, if you give that to me at one time, then we can start the process off relatively quickly. If we ask you for that and it takes us 3 or 4 weeks to get that back again, we can't move till we've got the info, because I've got no idea what your income is. So if we can't work out what your income is, we don't know how we can help. So potentially, getting prepared is going to really cut down that mortgage time. When you're buying a property, the average property time to completion now is a little bit long because conveyances are a bit backed up and everyone's a bit backed up. So look, yes, the actual mortgage going through after you found a property, the conveyance side of it comes on, slow it down. That can take maybe 3 or 4 months. Getting an agreement in principle, which says, will the lender potentially lend to me and lend to me this amount? With most lenders, it takes about 20 minutes or so, but we have to have all your details in. So getting an agreement in principle is really, really quick. Getting a mortgage isn't, super quick, but isn't super long either. Usually it takes them anywhere between, depending on lenders, can take between, 2 days and kind of, a month, depending on just how stacked up those lenders are. If that's really a concern, then we can put you through the lender. Is going to be potentially quicker, but your house purchase is going to take a long time anyway. So as long as your mortgage is there ready and waiting for when you want to go through, generally it's okay. But on average, mortgages will take a couple of weeks, 2-3 weeks, something like that.
Once you get a mortgage, you're committed to it for life. Prisoner sentence.
Well, hopefully it's nicer than a prison. I've just bought the wrong place.
That's true. Never know. I made a mistake.
As soon as the place you're looking at Reddit, it's a bit like a prison cell.
I hope not.
You're only committed to a mortgage for as long as you want it. There might be fees of kind of breaking out that mortgage potentially, but ultimately, I assume that when you have a mortgage, your end goal is going to be to pay that mortgage off so you can live in your home, rent free. So it means that we do come to retire. It should be easier for you later on in life, because at the end of the day, that's what I believe everyone kind of wants: to have their own residential property, own it outright, have no mortgage on it potentially, and it's just much nicer if you live rather than stressing about, will my pension cover my rentals which are going up, and you don't want to be like getting towards your end of retirement age and having to move from place to place, your landlord's changed their mind or whatever else, which is what so many people face. Surely the long-term goal is for you to have that mortgage. And yes, it will be a long-term goal. Yes, it might take 20, 25, 30, in some cases 35, 40 years, and it is a long time. Don't get me wrong. I mean, it's a really, really long time. But ultimately, you don't have to be forced into mortgage for any period of time. Say, for example, you went to buy a property, it didn't work out with you and your partner, for example, and you had to I don't know, split up and go separate ways or whatever else it is. You can always end that mortgage and look to get a different one at a later time if you want to. Sometimes there are some fines for breaking that, which are probably no different to a bit bigger because they're bigger amounts. But some mortgages have early repayment charges, and it's a bit like if you had a bit like any product really. If you had a mobile phone for 2 years and you want to leave your contractor after a year, they'd go, "Oh, hang on a second, you promised you'd be with us for 2 years." So yes, there might be some little fees for kind of breaking out of mortgages and so on, but you're not tied to a mortgage for any longer than what you want it. You can, if you want to, sell the property in time, walk away, but hopefully, your long-term goal is going to be maybe to go up as you go along, to maybe, have a long-term goal of getting a mortgage. But yes, properties are expensive, so mortgages will be long. It is now thought of that the average person now has to, in order to get a property of some kind, it's around about 7 times their income, and in central London, I know it's not easy, but it's literally about 13 times your income, which is, I can understand how some people are a bit frustrated and a bit, and a bit kind of upset. But we did an example of a property the other day where someone could buy in Southend, which is only a 55-minute commute. It's where our offices are. It's only a 55-minute commute into London, which I know is not great for everybody. Some people might not want to do that, but potentially it is possible to live and work in London with that commute every single day and actually own your own property rather than trying to rent in central London, nothing to show for it for kind of 25 or 30 years. So but no, once you get a mortgage, you're not committed to it for life. Hopefully you're only committed to it for, or you want to do it for as long as you want to do it, but the end goal is going to be to pay that property off. And look, if you win the lottery, you haven't got to worry about that stuff anymore. But the problem is not everyone wins lottery every day, so we have to look at a long-term plan, which is hopefully what people want to end up. We want to end up with people actually owning their own properties. So what have you got next?
Next one. You can't get a mortgage if you have an overdraft.
I hope not. I've got a massive overdraft. No, that's not true. Look, if you have any debts, a lender's going to want to know what those are and how much they cost a month, and they're going to want to take that out of your affordability and just make sure that you can afford that. So we'll look at what you've got coming in, what you got going out, what you got left over, and your lender's going to be based around that. So yes, if you have an overdraft, if you have a loan, if you have a car loan, if you have tons of money on credit cards, then yes, you might be able to borrow a bit less than what you could borrow before. But it doesn't mean that you can't borrow anything.
And you need a massive deposit.
A massive deposit. Massive.
Bloody huge.
Well, look, it's all relative, and a 5% deposit is still, a blinking lot of money. Yeah. It's more than most people would spend on a car, for example. And it's all going to be so area dependent. Whenever you ask questions like this, it's people, up in Scotland going, "Oh, you can buy a car stop in Scotland for this," or people in London going, "You can't buy a shed for this," which is true. So it's all relative for kind of where you are. Yeah. But the minimum deposit you're going to need is probably going to be around about 5% as a deposit. Depending on areas, that might be a lot. That might be a bit less. And it is going to take a bit of time to kind of save for that deposit. Over and above that, a 5% deposit, you're also going to need as well some money for your legals, probably maybe somewhere between £1,500 to £2,000 for legals. You're probably going to want to have like an MOT check on the property. You're probably going to want to have a home buyer's report. That's going to probably be about another, £500 or so. There might be some other costs. You just want to leave a little bit aside for your costs as well as your deposit. Yeah. But really, people are letting the government have got a scheme at the moment whereby kind of a government-backed scheme whereby you can buy property with a 5% deposit. There's also various other schemes like Help to Buy schemes, Help to Buy London. We looked at example Help to Buy London whereby someone bought a flat in London. They saved up a 5% deposit. Both those they end up buying a 2-bedroom flat in London, but they're both on I think 32 grand a year, which is still a chunk of money, but for central London's not too terrible at all. And they end up buying themselves a nice 2-bedroom flat on a new build with Help to Buy London. There are some lenders that will even let you take a loan as a deposit. For example, we did a video around this a little while ago, and there are some lenders which, not some lenders, there's only one really, which will let you have a loan as a deposit. So it's possible to have a personal loan from another area and look to use that as a deposit. Again, we used a property, for example, around about 160,000, and that client actually took out a personal loan just over £10,000 to cover kind of all of their costs. So you don't need a massive deposit, but you will need some deposit, whether it be gifted, whether it be borrowed, whether it be whatever else it is, because lenders are going to want to see that you've made some effort on your part, because they're going to give you the other 95%. So they just want to see that you've got a desire to kind of stay in that property if something went wrong. And normally working hard to get a deposit normally shows that kind of promise I'm going to try as hard as I can if stuff does get tough to keep it. And things will get tough moving forwards as well. Rates are going to increase a little bit. Cost of living crisis is not fun. It's hitting us all. So look, it will get a little bit tougher. But yes, lenders just want to see that you've got some deposit, just to make sure if they did have to take the property off you, didn't pay your mortgage, they have to take the property off it and repossess it, they stand a good chance of getting most of their money back.
My final myth of the day is that lenders will all give you the same deal.
No, that is definitely a myth. All lenders' deals are just completely and utterly different. When you're talking about deals, it's not always about a deal. So just because it's the cheapest deal, that deal might not apply for you. It might not be good for you. They might not borrow you as much money as someone else would, for example. They might better borrow you because you're trying to buy a thatched house. So it's not necessarily all about the numbers. A lot to do with numbers, don't get me wrong, but some of it's more about the criteria as well, and about where you're going to fit. But no, all lenders will kind of give you different deals, and it's about working with someone who really knows their way around the market to be able to give you the best deal for you, basically, and explain the reasons why that's the best deal. I would say definitely shop around for anything like you would your mobile phone, your bills, your car insurance, your whatever else. You should have every right to do it with mortgages and definitely get the best deals available to you.
That's all I've got.
Is that it? All your questions done?
That's all my myths. Debunked all of them.
Busted.
Yeah.
I feel quite proud.
Mortgage myth busters.
That was a mouthful.
Yeah, I struggled with that.
Cool, right. So thank you very much, everyone. That's all we've got time for today. Thanks for listening. If you found us helpful, don't forget to follow, subscribe, and hit that bell button to be notified of new episodes. So I hope to see you all So I hope to see you all again next week.
Bye-bye.